Members of the fund, thank you for taking the time to meet with us today. My name is Corey, and I am here with my partners, Francisco, Sean, and Brad. As the fund managers for Stable Capital Partners' flagship fund, we wanted to meet with you today to discuss the state of the current fund. Stable Capital Partners has a long track record of successful financial investments that has resulted in a gross annual value in excess of $3 billion. The cornerstone of our investment philosophy has always been to focus on high return assets in markets that show a significant potential for growth. As a result of our successful track record, the fund has been identified by a university who has expressed interest in investing $200 million with the fund. The fund managers have worked directly with the university to better understand the asset allocation and investment strategies and philosophy. Based on this analysis, we have determined that we are overweight in the multifamily market and that the university has also expressed concerns about our office allocation. The fund managers have worked with this analysis to determine if there are any viable alternative strategies that we should be pursuing. As a result of this analysis, we have determined that there are three target strategies to pursue moving forward. The first would be to sell our existing asset and to reinvest the proceeds into an underweight asset class in a market that shows significant growth potential. The second option would be to continue to hold our property as it is and focus on either renewing our tenant or, should they vacate at their lease expiration, to release it to another office tenant. Our third scenario would be to execute a buyout option with our existing tenant today and to convert the property into a life sciences building. Looking more specifically at our property, it is a 200,000 square foot single tenant office building. We currently have an investment grade technology tenant in the property who has 3 years of lease term remaining. This tenant has been working remotely due to COVID, and their future occupancy plans are uncertain. They have expressed to the fund that they are looking at exploring sublease options as well as a potential for a buyout. Before we make a decision on which scenario we would like to pursue, we wanted to look at the national landscape for both the office and life sciences markets to determine what the national trends were. Office has recently been in a slump due to COVID, and this is because the work from home model has proven to be successful for companies. As a result, around 10% of companies have stated that they plan to continue this work from home model in the future and are looking to decrease their office footprint in the future. Life sciences, on the other hand, has seen 16% growth throughout the past 5 years and is also experiencing record levels of employment in 2021. This life sciences market has also shown no signs of slowing down in the near term moving forward. Focusing more specifically on our market, the office inventory is currently at 103 million square feet, with 6 million square feet of inventory expected to deliver in the near future. Our occupancy rate is currently at 87%, and the tenant demand is both weak and uncertain. As a result of this influx of inventory and lack of demand, the fund is not optimistic about the future office market. The life sciences market currently has 10 million square feet and is essentially fully occupied. In addition, there is another 500,000 square feet of tenant demand that cannot be satisfied by the current inventory in place. To solve for this, there is 3 million square feet of inventory that is currently under construction and expecting to deliver in the very near future, with an additional 1 million square feet in the entitlements and pre-planning stages. While the fund is concerned about this influx of inventory, with the growth of life sciences over the past few years and the strong projections in the future, the fund is optimistic about the life sciences market.
All right, thank you. We'd like to update the board on as to the macroeconomic environment, current property trends, and also our thinking as Stable Capital Partners as to positioning moving forward. So after nearly 5 quarters of a pandemic, the economy has been recovering quite well, navigating uncertainty along the way. The Fed recently raised its GDP projections for next year, 2022, to 3.8%. Consumers and businesses are sitting on all-time high levels of capital on their balance sheet. Transaction volumes have also rebounded nearly to pre-pandemic levels. And the economy overall has benefited from historically low interest rates, with the US 10-year sitting at 1.57%, and an environment with the 10-year sitting sub 2% ever since 2012. Looking at the historical trends across asset classes prior to the pandemic, most of the major food groups have shown significant strength. So retail and multifamily have underperformed since the pandemic, which has caused dislocations in the market and created opportunities. Retail suffering due to everyone shopping online, and of course office underperforming due to the work from home. Meanwhile, industrial has benefited from the e-commerce wave, and life sciences has grown as a newer sector with strength in strong demand for tenant space and strong market rents. Multifamily has also done quite well during the pandemic, and Stable Capital Partners has benefited from being overweight the asset type. Specifically on a relative basis, apartments have outperformed other categories, 60 bips of compression ever since 2Q, the start of the pandemic in 2020. And on an absolute basis, the apartment sector also enjoys the strongest cap rate at 3.5%. Now, looking forward, it's important for Stable Capital Partners to think about how we position ourselves with the environment to come. An important factor to consider here is inflation. We just hit a 31-year record high with core CPI hitting 4.6% in October. Biden on Monday was able to pass the infrastructure bill. Therefore, inflation becomes key and top of mind. Firstly, we expect that the tapering of dovish monetary policy will help offset the impact of inflation on our commercial real estate returns. Secondly, it is our view that GDP growth is an even stronger predictor of commercial real estate returns. And this GDP growth we do expect to be on the horizon given recent Fed GDP projections. In this kind of environment in general, certain asset types will outperform, those with shorter weighted average lease terms, a triple net lease structure, and also those with strong fundamentals that drive strong rent growth that will outpace inflation. And that's why, for these reasons, among others, for example, office as a category is one that we expect will continue to underperform given the longer lease structure and the weak demand. Meanwhile, life sciences, we expect to fare quite well given the strong tenant demand for space, bolstered by VC funding and government NIH funding at record levels.
Well, the clicker, I think.
Yeah, the clicker's there.
Oh, that's what. Okay. I'll point it wherever you need me to here. No dice?
Can you just advance up there? It's stuck back here. There we go.
I went too far.
Went way too far now.
Nope.
Oh, no, that's right.
Okay. All right. I'm going to talk about the scenarios, the first two. The first scenario being to immediately sell the property and then reinvest our funds elsewhere. We see strengths in this scenario being we're able to exit the current risky state of the traditional office sector. We think that's a major pro, and we also see it as an opportunity to invest in the industrial space, which the fund is currently underweight in. Weaknesses in this approach is that we do see it returning lower returns than our fund typically likes to invest in. And because this industrial market is so hot, there is sky-high valuations, which we think lowers our upside. Working into the financial returns of this strategy, we think on the sale of the current property, we could earn 9 to 10% IRR, and then on that industrial reinvestment would get about a 6% IRR. For scenario 2, which would be to hold on to the property and release it once the current lease is expired, We see strengths in this, that there's no real major CapEx that's needed in order to execute this strategy. We also realize that our current rents are well below market, so we do see some room for growth there. The weaknesses, which we touched upon earlier, is that there is a chance of increased vacancy in the traditional office space due to the adoption of working from home. And then we also, there is a possibility that there's a longer downtime in between leases in the office sector. For scenario 2, we underwrote a 9.09% levered IRR with a 1.4 multiple on this investment. Diving into some of the cash flows, we think it would be best in this scenario to refinance in Q4 of 2021 to benefit from a more favorable interest rate. That being said, there will be challenges in year 4 as that's the renewal period as well as the end of the interest-only periods. So when we were underwriting, we thought a base rent of $50 per square foot was a realistic approach. Right now, the market's about a little over $57 a square foot. So $50 is about 87% under that. We think that's realistic given the oversupply and the projected decrease in demand in the office space. We also thought it was a conservative exit cap to keep that constant at 4.85%. When we were running our sensitivity analysis on the scenario, we saw there's a wide range of returns, worst case being in the negatives and best case being approximately 19% IRR. But we really think that the most realistic out of all those options is that 9.09%. So that's the one we ended up sticking with.
Okay, scenario 3. This is the life science conversion option. So the strengths of this, life science we can do a much higher rent per square foot with the rent science when compared to traditional office. We also have a strong, experienced development partner, and we're in a top 5 life science market. In terms of weaknesses, this option does have significant equity requirements, both in terms of redevelopment and tenant improvements. And the normal life science tenant does prefer a smaller space, approximately 15 to 30,000 square feet. So we do anticipate having to have numerous tenants going forward. The opportunity here is really unique. We're able to transition from a weak office market to a strong life science market without having to pay the expense of ground-up development or to buy existing properties at the current high valuations. And based on our calculation, compared to a ground-up construction, there's a nominal price savings of $20 million. And if you include interest expense, it's closer to a $9 million savings. So either way, significant cost efficiencies. The other opportunity is what I consider a cap rate arbitrage. So we're going from office cap rates to a life science cap rate on exit, and that's a 93 basis point difference for the current market, which potentially provides tremendous upside value on exit. Our main threat for this is the 4 million square feet that are currently either in development or entitlements. But given that we are in a fast-growing life science cluster, current demand outstrips supply, and forecasts are for strong growth in this industry, we feel confident in this investment thesis. So going into the financial returns, you can see across all metrics, we're seeing very strong performance. And going into the cash flows, there are negative cash flows to begin the investment hold period based on the redevelopment and the tenant improvements, but tremendous upside on the exit. So the real strength of this option is those high returns are achieved with conservative underwriting. So for instance, we underwrote a base rent of $63 per square foot. That is currently $5 per square foot below market. We also included the $50 million TI allowance, and that is $10 million above market. And we did that, one, to account for the new supply, but also we want to be attractive to tenants. We also modeled several other iterations, considering what happens if our construction timeline, if we go past the timeline, what happens if lease-up goes longer, what if we have to provide free rent. And in all those situations, we're able to achieve our fund-mandated returns. So looking at our two variable sensitivity table with cap rates and base rent, we'll see even in the worst case scenario with significant cap rate expansion and much lower than market base rent, we're still able to receive a 12% levered IRR. To quickly go over the partnership structure, SCP is the limited partner. We'll provide 97.5% of the initial equity investment, with the operator providing the remaining 2.5%. There is a 9% preferred return, so we'll have pro rata distributions of cash flow up to that 9%. And then after the 9%, it will be a 75-25 split to the LP and GP respectively. And you can see the LP and GP specific returns. Because the promote structure works in favor of the operator, the SCP returns are slightly below the project, but still very strong at 22% levered IRR and approximately a 2x multiple. And the GP does have a high return, but that's really a result of the small initial equity investment, and we're compensating them for all the development work that they're doing over the course of the hold period. All right, and then transitioning into our recommendations. Just a quick recap of our options. Number one is we sell the office property and we reinvest into a new core plus investment. The number two is holding the office property and releasing either to the existing tenant or to new. And the third one is buying out the tenant and executing the conversion to life science. So now we want to look at the finances of these three options. So our strategy is we first wanted to compare scenario 1 and 2. Scenario 2 has the risky proposition of having to release the office building in a weak office market. And given the lower IRRs that this option has, we don't believe we're adequately compensated for that risk. And for that reason, of those two, we prefer scenario 1. We're able to exit the weak office market and still get a 9 to 10% IRR, and then we're able to transition to a stronger industrial market with favorable financing. But with that said, when we compare scenario 1 to scenario 3, it's clear that the conversion really outperforms the other options by every main financial metric. So our key takeaways are that COVID really changed the commercial real estate game. And if you're an office property owner, you need to take very seriously the threat to this office market with trends like work from home. Accordingly, it's time to change, it's time to adapt, and it's time to take calculated risk, like doing a life science conversion, in order to capitalize on this economic recovery. And with that, our decision is we highly recommend going with option 3, the conversion. And thank you for your time, and we're here for any questions.
Judges, any questions?
Yes.
So a 3-month lease up on your conversion option seems pretty brisk. How did you get comfortable with that?
Yeah, so we looked at the current market, and what we saw is if they had rents that were slightly below market or they had slightly higher TIs, that they were able to accomplish that 3-month lease up. In addition, we determined that we would be working to pre-lease that space during our development period that could help us. And finally, we did model other outcomes where it was extended to 6 months. They were still all above the fund mandated 11 to 13. Of course, if you took all the worst case scenarios, it would be below that, but all realistic situations delivered our fund mandated returns.
And we also factored in additional TI to help incentivize tenants to come to our property over our competitors to help offset for that extended downtime as well.
And we preferentially modeled that we'd prefer to give, higher TI, because that's less detrimental to the project IRR than having a longer lease-up term. Yeah, so we looked at the nominal profit for all the different properties, and we do assess that the conversion is more opportunistic, more risk, more reward, but we thought from a portfolio perspective that it would balance out and it was the appropriate course of action.
Yeah, we also saw the two, scenario 1 and scenario 2 was below our threshold of returns, and so we thought if it was the worst case scenario on scenario 3, we're still at that like 12% IRR mark, which is right in our bread and butter. So,
Are you talking about for ground up development versus a conversion?
I think that's a valid question.
Yeah, we did look at the price per square foot on the sales data. I don't recall it off the top of my head, but we were noticeably less expensive than the recent comps on a per square foot basis. It was in line with the difference between the construction and the conversion. I can't remember the
I
numbers.
think the
off the top
average
of my
per
head.
square foot was $65 a square foot on the life sciences, and we were at 60. So,
Oh, per month.
yeah.
Any other questions?
Great.
All right. Well,
Thank
thank you all for your time.